Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, stocks drop and bonds gain amid the government shutdown and a weak ADP jobs report. We'll have full coverage ahead. Plus, we'll hear from the CEO of Union Pacific to discuss its $85 billion deal for Norfolk Southern. And we'll hear from Ford CEO Jim Farley on the state of autos amid President Trump's trade war. Taking a look at the major averages here, and what we're seeing today is a little bit of a settle-off, albeit a relatively modest one. We've got the Dow right now down about 76 points, not even 0.2%. The S&P 500 off about a third, and the NASDAQ Composite off about 0.5%. Now, as we've been discussing, not just this morning, but really for days here, we do not tend to see an overly negative reaction in markets when there is a government shutdown. However, the beginning, there's a little bit of jitters. There's still some uncertainties about how exactly it's going to play out, and also importantly, how long it's going to last. So that's one of the things that's putting pressure on stocks today. But we also want to look across the asset spectrum. We're seeing yields come down a little bit. So it looks like some buying of treasuries, perhaps, as we do get this nervousness. Yields off by about 5 basis points this morning. Likewise, the dollar seeing a little bit of weakness. We've been talking a lot about the bounce in gold this morning, pushing up towards $3,900 an ounce, and Bitcoin, digital gold, as some call it, it's also getting a bid here above 116,000 per Bitcoin. Digging more into what's going on in the stock market, though, we've got healthcare and utilities, traditional defensive sectors that are limiting losses here. But on the downside, we've got those cyclical sectors, the more economically sensitive areas like communication services, financials, and industrials that are feeling some pain today. And I always like to check on the NASDAQ 100 and large cap tech as well. Here, we have a pretty mixed picture here of what's going on. It looks like Meta of large cap tech is doing the worst today, down by nearly 3%. Now let's get more on the government shutdown. It could reduce GDP by 0.1 of a percentage point to 0.2 of percentage points for each week that it drags on. That's according to economist estimates. The last shutdown resulted in a loss of $3 billion in real gross domestic product for the fourth quarter of 2018 and the first quarter of 2019. Joining me now is Brian Gardner, Stifel Chief Washington Policy Strategist. Brian, it's good to see you. Here we go again. So how are you looking at this particular shutdown? And importantly, how is this different, if it is, from other shutdowns that we've seen?
Well, the most notable difference from the previous shutdown is that shutdown, the 2018-2019 shutdown, was only a partial shutdown, right? There were parts of the government that were already funded. So people talk about it, and I do all the time, in terms of the longest shutdown. It was 34, 35 days. But it wasn't a complete shutdown. And by the way, during that shutdown, if you look at the before and after, the equity markets were up about 10%. So investors just shrugged this off. How could this be different? If it is a full shutdown that lasts a long time, this could be different from 2018, but the initial signals are this may not be quite as long as people might fear it to be.
Spell that out for me, Brian, because when you have Hakeem Jeffries and Chuck Schumer going into the president's office and he's got 2028 hats lined up, that's not exactly a very welcoming stance to begin negotiations necessarily. I mean, and both sides are pretty entrenched here. So what signs of optimism are you seeing?
I think the vote in the Senate last evening is the signal of where we're heading and how quickly we may be heading. For those who didn't see it, 3 Democrats broke ranks. They voted for the Republican plan to fund the government temporarily. I sense some more anxiety behind the scenes. The leadership cannot go along with the Republican plan. They cannot be seen as cooperating with the Republicans. There was a lot of pushback against Senate Minority Leader Schumer in March when he did that on a previous funding bill. So he's kind of boxed in, but that doesn't mean that his members are boxed in. And I think you're starting to see moderate Democrats, and I suspect we'll start to see some Democrats who are going into 2026 reelection campaigns who will break ranks at some point. I don't think they think they have a strong hand, And I think they believe that a prolonged shutdown could come back to haunt them when they go back to the ballot, when voters go back to the ballots next year.
I'm curious if they do end up voting to keep the government open, at least for another few months, buy themselves another few months to continue negotiating. Do you think the Democrats will end up getting some of the extension of Affordable Care Act benefits, some of the reversal of Medicaid cuts that they had been pushing for? Is there any chance of that?
So let's break them out. The Medicaid cuts, I think probably not. It's tough to see Republicans shifting so quickly after passing those cuts as part of one big, beautiful bill. The Obamacare subsidies are a little bit different. Those are enhanced subsidies, right? We've always had subsidies for the Obamacare plans. They were increased during COVID because of the pandemic and economic fears. Those enhanced subsidies expire at year end. And I think there are some Republicans that are wary of them expiring. They don't want to go into a reelection campaign with a bunch of voters having their insurance premiums get hiked up. There could be some reforms, some modifications to those enhanced subsidies, but I think there is a deal to be had for some kind of increase by year end. I just don't think the Democrats' hand of playing that right now is particularly strong, but it will get stronger at the end of the year. So we'll see how it plays out.
It's interesting because it doesn't feel like a short shutdown is necessarily the base case for markets. So even though we keep saying, stocks don't tend to perform badly during these things, do you think there's potential case for upside if it ends up being pretty quick?
There could be a relief rally, sure. I mean, to the extent there is some fear, and by the way, I don't see that fear right now, right? If you look at the VIX, it's pretty stable. Yes, there is some weakness in the dollar, but there's been weakness in the dollar all year. The bond market is kind of following its more recent trend of showing some strength. We don't see any changes in the overall trends of these various markets to suggest that there's some kind of fear or trepidation going on. That being said, it would not surprise me if there is a deal Friday night over the weekend that Monday morning, or pick whatever day, we get that deal, that there could be some kind of relief rally in the equity markets.
And Brian, I'm also curious what you're hearing in terms of this threat from the administration to make some of these furloughs more permanent cuts. If it's a very short shutdown, do you think that's off the table and not a threat? Because obviously that feeds through into some of the job market concerns that the market has had.
Yeah, I just don't know how valid the threat is, whether it's just a negotiating ploy, and I suspect it is. There are questions that I get from investors and from issuers, in various sectors of what that could mean, and I don't think anybody knows right now. Look, we've already gone through a number of furloughs and layoffs as part of the DOGE cuts. And I think some people, some participants in various industries and sectors would say that has had an impact, but they never are able to quite quantify what that impact is. Another round of deep cuts, not just around the margin, but deep cuts, does start to get to the efficiency of various agencies and how they regulate different entities. So there could be an impact down the road. But again, I have a feeling this is more of a negotiating tactic by the White House, less of a real threat. But again, it's one of those things we'll see as time plays out.
Brian, just finally, switching gears a little bit. I mean, amidst the fire hose of news, we haven't talked about tariffs, some of which some new ones went into effect today. We've been so busy talking about the shutdown. So I'm curious what your thoughts are on this latest round that go into effect today. And then, of course, there's some more that go into effect in a couple of weeks. I just recently was speaking with a bank CEO, and he said, at some point this will all sort of settle down. And I said, will it though? I'm curious what you think in terms of when we're going to find some sort of equilibrium or stability with the tariffs.
That's probably going to be a while. We first have to get through the Supreme Court case. Until that is settled, there's going to be a lot of uncertainty around the tariff situation, because let's just hypothetically say that the Trump administration loses that case. Well, then they will then pivot to Plan B. And we don't know exactly what Plan B is yet. We know what some of the options are. Section 338 of the trade laws. You could revert back to some of the trade laws they've used for other items. those tariffs would probably be more limited in scope, so they would not be as far-ranging as the reciprocal tariffs that are being litigated. But until we get through that, we don't know exactly how it's going to play out. So I think the tariff story is going to be a rolling story that's going to last 6 months into next year. We'll get the Supreme Court decision probably year end. But even after that, I think investors have to now understand, and I think many of them do, that tariffs are going to be an ongoing weapon for this administration in foreign policy. So they're never going to go away. They will always come back as a tool that the administration wants to use when negotiating with foreign trading partners and foreign adversaries.
Brian, great to get your perspective this morning. Thank you.
Thank you, Julie.
Well, indeed, the U.S. government is shut down after Congress failed to pass a funding bill. Typically, stocks perform relatively well in the months following a shutdown, but this time there are several additional factors at play, including delays of economic data the Fed uses to determine future rate cuts. Joining me now, Ben Emmons, FedWatch Advisors founder and chief investment officer. Ben, it's good to see you. Now, maybe Brian is right, who we were just speaking to. Maybe this shutdown won't last very long. But be that as it may, it looks likely, at least possible, that we will not get Friday's jobs report. This morning's ADP report showed a drop of 32,000 jobs. So how are you thinking, what do you do in this situation?
Well, we should definitely trade the ADP number, so to speak, right?
Yeah.
Meaning it's definitely a trend that's now turning negative. And the ADP has become more accurate of what the actual labor situation really is. I mean, it accounts for people on the payroll, private payrolls, so not the government, but nonetheless, it's becoming a more important number. So you see the reaction in the market this morning. Yields declined on it. The probability for the rate cut for October went over 100%. So the market knows these types of numbers are going to drive the Fed towards an outcome of potentially having to cut rates at several meetings to make sure that the unemployment rate doesn't go up that quickly. So I think that's the implication.
I just want to pause for just 1 second, because traditionally you have ADP come out, and then a few days later, you have the government data come out on jobs. And I feel like traditionally economists, not that they've discounted ADP, but generally the government data has been viewed as higher quality and more reliable and giving us a better picture of what's going on. Has that changed? Why do you think that is? And how should we view, with what degree of certainty do we look at the ADP number? Of course, the government numbers keep getting revised too. So put that in the, as we talk about it, put that in the hat.
Yeah, I think if you think of it statistically, the challenge with the non-farm payroll is that it's 2 surveys. One counts for 2 jobs, the other one 1. So you get that nuance there. Plus there's this birth-death model that's accounting people for, in the payroll when they open a business, but when they close a business, they don't. And it has over many years caused this fluctuation in the non-farm payroll number that you haven't seen in the ADP number, which, by the way, revises methodology. And I think when that happened, people sort of took 2 and 2 and say, I got a better gauge here where we're heading, in addition to the ISM numbers, which, by the way, always important too, of the employment components there that are kind of forward-looking, how industries think about hiring from here. So I think the payroll number, it's not controversial, because when I started in the 90s trading, you also had a lot of fluctuation in number too. It's no different than it is today. But I do think that the markets have taken this ADP number more seriously. So that's why I felt that probability moving this morning so quickly on this number was telling that the market that the Feds were taking cue from it, saying, yeah, we got to watch the labor market here. Like Colin said yesterday from the Boston Fed, was kind of telling, there's significant demand shortfall to supply in labor. That's language to me that's about alarm. It's about we're going to pull the handbrake if we're seeing this labor market deteriorate. So ADP seems to be indicating it.
So all of that said, let's say the government remains shut. We don't get the jobs data on Friday. If it remains shut through CPI, I don't know what we say about that. But do you think that the Fed has enough with what we know right now to cut at the next meeting?
So Waller put in a speech the other day that the Fed's also looking at a weekly payroll number. They sort of use different surveys and construct what actually the non-farm payroll number should be like. I think that probably is for them from a, let's say, staff research point of view.
So they don't rely on government data for that?
Exactly. So they use all private data to get a similar estimate as what non-farm payrolls would be that's interesting because I think if they have that data, they probably have enough to say we can make our decision well informed. Nonetheless, as Collins yesterday said, if this BLS data becomes more problematic, it becomes indeed problematic for the decision. So that maybe in November or December, more problematic. So we'll have to see. I think at this October meeting, this is probably a pretty set probability that they're going to move because as this data just now indicates today, yeah, we're really sliding down with payrolls.
So what does all of this mean for yields as well going forward?
So it was really notable on Friday that we didn't break above the 50-day moving average. That's maybe a big technical idea, but it's sort of in a downtrend. And it's sort of, I think, saying that we've got a lot of uncertainty, as your guest says, like this tariff uncertainty, for example, is really still overhanging the economy. A lot of companies are reporting on it, like we just don't really know what we're going to expect here. So I think that puts pressure on yields downward, even though that the GDP data and the real GDP data is actually higher and increasing or strengthening. So I think yields are going to go a little lower from here, simply because it has to discount that the Fed has to do several rate cuts to make sure that this payroll data stays in check. I think that's the trend here.
Ben, good to see you.
Good to see you.
Thanks for coming in. Appreciate it. We got much more markets action coming up. Stay tuned. You are watching Market Catalysts.
All right, joining me now is Union Pacific CEO Jim Vena here at the Michigan Central Station in Detroit at Ford's big Essential Economy event. Jim, good to finally meet you.
Well, listen, my pleasure.
Yeah, really.
Nice to meet you,
yeah,
Brian.
likewise.
Really.
Been following
Thank you.
your story, many decades in the railroad career, railroad industry, and I think that's perhaps a good segue into how important an event like this is. I was just talking to Ford CEO Jim Farley, telling me there's a worker shortage in critical industries. How hard is it to get people to drive a train? You used to drive a train. Why aren't more people driving trains?
Well, listen, good. You did a little research and you said this guy actually, but that's a long time ago, and things have changed. The number of people that we had on the trains were double what we have now, at least, and technology has advanced. And what we find is because of the type of jobs we have, we really don't have a problem attracting people. We attract people that want to work where they're not directed all the time by a supervisor. We find people that want to be able to move big things like trains and fix big things like rail cars. So and we hire across the board. We hire outside. Everybody thinks about locomotive engineers and conductors and somebody who repairs a bridge, but we have technicians. We have electrical technicians for locomotives. We have lawyers. I don't know why, but we do. So we have quite a range, and so far, and I think it's driven by what the compensation is and how we treat our employees, that we don't have a real problem hiring. At this point, any job that we put up, we're able to find people that want to do it. And we hire veterans. We have 18% of the people that work at Union Pacific are veterans of some sort, so we love it, and it's a great place.
If I were to go work for you today, how much can I make working on a rail line? Because I think there is that, I joked to Jim Farley, this generation would love to put TikTok videos online thinking they might make $100,000 when you could get paid very well for these jobs.
Yeah, if you put in the benefits, what we pay, and we put it out there, on average, with benefits and the salaries and everything, we're talking about $140,000 to $150,000 a year. So they're good paying jobs.
Do you see, what is the blunt reality if we can't have people come and fill these jobs for the economy? What does it mean for the economy?
I think you always have to be looking at how you can become more productive using technology. And if we actually got to the place where you have to stop movement and innovation doesn't keep up, then you've got a problem. But I think the entire American experience is that innovation drives at the same time, and you might have a little bit segments in time where you have some issues, but overall innovation will drive it where you are able to move ahead, and if you have a limited number of resources of whatever, people or whatever, that you're able to get through it. And that's what we found.
The Trump administration has really focused on bringing jobs and manufacturing back to this country. What does that inevitable increase in demand mean for the country's supply chain?
I think it's a great thing. If you can have more Americans working with more options and more products made in the United States of America, it's great for the economy. It's great for the workers, and it'll draw more people that are not working, that today are not part of the workforce. They'll come and be part of the workforce. I think there's still a lot of room for the workforce and the number of people working in the United States of America to grow, even with the population we have.
I've always viewed Union Pacific as one of the more leading indicator railroads because you are a major carrier or holder of automobiles. I mean, that's why, you're a great tie-in to this event.
Right.
What is the demand outlook like? What is the demand saying about the outlook for the U.S. economy?
Let me say this, is we get to see products. We probably move about 500 products that people use every day that are at large volumes. So whether it's automobiles, automobile parts, whether it's the frame for automobiles, whether it's paints that people use, or ladders, or you name it. So it's interesting in that the consumer, from everything we see, is still strong at this point. They are still out there spending. They're still out there moving. We've seen some products being a little bit less. Homes are not selling at the same rate as they were before, but overall our business is up. Our volume is strong year over year. It's up by a few percentage points. So far we have not seen the impact that some people claim that we were going to have with the economy.
So you don't see there's no material slowdown happening?
In specific segments there is, you can see that, but in other parts it's moving really good.
Jim, I know you got to get on stage here, and my time is brief. You're right smack in the middle of an $85 billion deal for Norfolk Southern. Would create, if this is done, by the end of 2027, would create the country's first transcontinental railroad. Where are you at in submitting a formal proposal to the STB?
Well, Brian, thanks for the question. I think we are within 4 to 6 weeks to be able to put the formal merger application in, and then we'll go through the process. In the extreme time that the STB takes, it would take us maybe till the end of 26 to get it done. We think it's such a compelling story. It's good for America. It really is. You know, we're one of the few industrial countries that doesn't have a railway transportation system that can be seamless from one end to the other. How would you love it if you had to fly across the United States of America, and every time you flew, you had to stop in Chicago, change
you're
planes.
Making me shake just even thinking about that.
Change planes, change terminals, change everything, and that's what we're doing. So we're going to speed up. It's good for our customers. None of them will lose any of the competitiveness that they had with what we're going to offer in the merger, and we're so sure of it that we've guaranteed a job for every unionized employee that works for Union Pacific or Norfolk Southern.
Now time for some of today's trending tickers. We are watching AES, Ford, and Carvana. First up, AES. Shares of the power company surging as BlackRock's Global Infrastructure Partners is reportedly in talks to buy the company. According to Bloomberg, an agreement could be reached as early as this week. The company has an enterprise value of about $38 billion, including debt. Next up, Ford, the company out with its third quarter auto sales data. Overall sales up 8.2% in the last quarter, while EV sales jumped by 30%. Sales of Ford's SUVs increased nearly 10% during the quarter, including massive gains for its larger SUVs, as well as the Mustang Mach-E EV. That was up 51% from a year earlier. EV sales notably higher for the quarter as buyers rushed to get those vehicles before the end of federal tax incentives. And Carvana, the online car buying platform, getting an upgrade on Wall Street. Jefferies analysts raising the stock to buy from hold and boosting their price target to $475 from $385. The analysts see the company continuing to deliver elevated growth and upside to consensus. They also say it's best positioned to benefit from a shift to digital in the massive $800 billion used car market. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. We got much more markets action coming up. Stay tuned. You're watching Market Catalysts. Yahoo Finance executive editor Brian Sozzi caught up with Ford CEO Jim Farley at the Ford Pro Accelerate conference in Detroit. That was yesterday. They discussed boosting productivity for essential American workers.
Factory workers, construction workers, farmers, all the people that move things, truck drivers, rail workers, and people fix things, plumbers, electricians, HVAC, all the people that basically work for our hands. Think with their hands. Think of like Mike Rowe, all of Mike Rowe's friends.
I love Mike Rowe.
Yeah.
Why is there a shortage of these workers?
Well, it's a complicated problem, but there is, let's put it that way, literally 1 million people openings right now. Technicians in dealerships working on cars. At Ford, we have 6,000, probably 400,000 repair technician shortages across the economy. I think it's a couple things. First of all, the productivity has not caught up with the white collar. In fact, it's gone down over the last 20 years. Number two, the jobs aren't as glamorous as a white collar job from college, which is kind of the primary path that our whole economy, investment was for new jobs. And I think the permitting and all the regulations has really stunted the growth of these kind of jobs. The one I focus about the most is kind of the society's view of these kind of jobs. When a plumber, electrician comes to your apartment or your business or to your house, how do you treat them? Do you treat it because these people are running our communities. And so many people take them for granted.
You're the only CEO, from what I can tell in the past year, that is out here holding a summit like this, trying to get new skills into the next generation of humans. Why aren't more CEOs focused on real world applications like this?
I think it's because maybe it's more acute for a company like Ford. Look, the president has policies for us to grow. We make 80% of our vehicles in the US. We're the largest automotive company in terms of manufacturing and exporting. And so we have the shortage of mechanics. This morning when I woke up, there were 6,000 bays in our dealerships with no technicians.
So can't get my car fixed?
Nope. 2 weeks. Average wait is 2 weeks. Not because we don't have the parts, we don't have the mechanics. Same when we went through the strike and the UAW worker, we had a 2-tier wage. Most of our entry workers in our factories are working 3 jobs. We solved that with the new contract. They get full wages, but we still have that stigma of working in a factory. So I saw these problems firsthand at Ford. When I talk to my pro customers, they're all small mom and pop plumbers, electricians, HVAC that go into New York City and fix the elevators and the AC when it goes out. Those small companies don't have a next generation coming up. They're all worried, what are they going to do with the shortfall of skill trades in this country? I guess we saw it first at Ford, and we're also a kind of company that doesn't like observing problems. We like fixing them.
What's the blunt reality if we can't get this fixed?
Inflation, delays. Right now, it's 10 years to build a bridge in our country. It'll be 20. You want all these data centers built? You got to be waiting, and it's going to cost a lot more than it should. And probably the bigger is the social cost of all these million jobs that could be great contributors to our economy that won't unless we do something. That's probably the biggest cost. When I'm 62 years old, I think more and more about that person, that million, one of those million people, how their life could be changed if they can be a mechanic at a Ford dealership, but they just don't know how to get from here to there.
President Trump has focused a lot on bringing back manufacturing to the U.S. Now, on paper, this sounds absolutely amazing.
Yes.
Well, what if we see that spike in demand and we don't have the workers to satisfy this?
Well, that's what's going to happen. That is what is happening right now. It'll be inflation. It'll be these projects take twice as long. I was talking to a construction CEO today, and he said, hey, this is a $4 billion, now it's going to be a $5 billion program. I just know, Jim, because I can't find, so I got to steal people and I have to pay more, which is great to some extent, but that million gap is not going away. It's getting worse. I love the president's policies, but if we don't backfill it with real programs, that's what we're trying to do here today, real progress, we are just going to pay more and get more and more frustrated.
What are the programs you're putting in place to address this?
Well, we have apprentice programs. We're starting to work with charity companies to spin up trade schools. We need to do a lot more on permitting, so the company has to go in, not at the national level, local and state level. We have a lot of progress to make there, and we need to invest as a company in productivity for our essential workers. I want my factory workers to catch up and pass my white-collar workers in productivity. That means we got to give them AI tools, and that's going to cost more, but it's the right thing to do. But not all companies have the resources for us. If you're a small mom-and-pop company of electricians, you do not have the resources of Ford Motor Company. I'm not worried about Ford. We'll do the right thing. I can't wait to tell everyone what we're doing. But what keeps me up at night is all those companies that don't have the resources we do.
Why I love your earnings call, Jim, is because you keep it real. And you kept it real with this number. $2 billion net tariff impact this year. How does that make you feel as a CEO of a company like Ford?
I mean, it's frustrating because we're the most American auto company and we export the most, and yet we have this $2 billion headwind, which prevents me from investing even more in the U.S. So it's frustrating, but I got to tell you, we've had some really good conversations with the Trump administration. I know, they feel our pain. I know they want to help us with this problem. What I've seen them do on the EPA side, really put the EPA tailpipe emissions more in line with customer real demand, that gives me hope that we're going to find a solution for that $2 billion parts bill.
Is the pain most acute in auto parts?
Yes, that's where it is. Basically, the tariffs should theoretically help Ford, whether it's bilateral from Japan or South Korea or Mexico or Canada. Our competitors make a lot of their trucks outside the U.S. I don't. I make 100% here. Theoretically, that's higher cost for them. The reality is, if you want to make it in the U.S., I have to import literally thousands of dollars of parts on F-150, the best-selling car in America, to make it affordable for people. It's already $700 a month. I don't want it to be $800. So that wiring loom or those fasteners that we don't even make in our country, I have to import. But I'm paying 25 to 70% tariff on those imported parts. It adds up to $2 billion. So that's what we're asking the administration for. Hey, help us make more in the U.S. by making these tariffs on the parts for cars more reasonable.
Last one before I let you go, Jim. You made a very powerful statement on stage, and I followed your whole EV journey. You said customers are not interested in $75,000 EVs.
Yes.
Is the reality that the EV market's just going to be smaller than people thought?
Yes, and I think we learn. I mean, it's anytime there's new technology. What if your Motorola and Apple comes along with the iPhone? Things changed when technology moves through an industry like electrification or software-defined vehicles are also changing our industry. We've learned. We've been number 2 to Tesla for 3 years, and we learned that people are not willing to pay $30,000 premium for that big battery on a $50,000, $60,000 utility. But they're willing to buy a $30,000 EV if they save $2,000 a year compared to gas costs. So the issue is we had to reload our capital on what we learned, move as fast as we can, and then we got to make sure we're future-proof to BYD. They have full support from the Chinese government. They've been at this for 20 years. They have a lot of good IP. Ford has to innovate to catch up with BYD because we're a global company. We're going to compete with them around the world. Electrification is not slowing down in China. It's not slowing down in the rest of the world. Maybe here in the US it is, but not the rest of the world. That's why we developed this innovative universal electric vehicle platform that's $30,000 affordable EV.
U.S. stocks have been on a tear as of late, closing out their strongest third quarter since 2020. That might put valuations out of reach for some investors. My next guest says to find growth, look outside the U.S. as international and emerging markets are rebounding. Let's bring in Kevin Carter, EMQQ Global founder and CIO, for this week's ETF report brought to you by Invesco QQQ. And indeed, EMQQ is an ETF that tracks the emerging markets. So we've seen it rise about, 34% this year. What has changed this year? Has it been, is it the sort of Sell America trade that came into the fore earlier this year that sort of catalyzed people to say, oh yeah, there's a whole world out there that's actually doing okay?
Well, I think it was exactly that. I mean, obviously the U.S. stock market's done very well for the last decade, led largely by technology companies. And for a number of reasons this year, the dollar's gotten weaker, our budget deficit, growing debt. And so people finally sort of shine the light over on what's going on with the technology companies in the emerging markets. The launch of DeepSeek, I think, also was an important thing this year that really had investors look at the Chinese internet companies and see how cheap they had become, because they've been very out of favor over the last few years. So, who knows if it will continue, but certainly this year, investors are much more interested in emerging markets than they have been in a long time.
And in tech and emerging markets specifically, which is where your ETF is, I want to sort of break down and talk about some of the various emerging markets. Latin America is really interesting. We've talked to some executives from companies like Mercado Libre and Nubank here at Yahoo Finance, and those stocks have done well. So Latin America, what is the sort of emerging story there, if there is sort of an overarching?
Sure. Well, the story of EMQQ, and I think that really the biggest growth story in the world for the next 10 years and the next 20 years is the rise of 6.5 billion new consumers in emerging markets, including Latin America. They're getting their first ever computer, which is not a desktop, it's an Android-based smartphone that gets better and more affordable every year. And they're getting the internet for the first time. And they're going online at an incredible rate, and they're leapfrogging a lot of the things we've done. They're never going to have a traditional bank account. They're going straight to online payments. And so now Latin America, amongst the emerging markets, Latin America is 650 million people. They're a little bit more developed than, say, India and other parts of the world in terms of the GDP. And Mercado Libre and Nubank they're the leaders. Mercado Libre is now the largest company in Latin America. It's been the best performing stock in Latin America. And it is the Amazon.com of every part of Latin America, but it's also a lot more because they've also got a financial services business. So you can call it the Amazon of Brazil, but you can't call Amazon the Mercado Libre of anything, because imagine if everyone bought their stocks and ETFs at Amazon.
Right.
That's what Mercado Libre also has with its Mercado Pago. So Latin America is definitely a big, important part of this.
Well, let me ask you this, and this is a question that goes for Latin America, but it goes for emerging markets generally. One of the knocks on emerging markets, and Latin America probably even more specifically, is the political instability, right? Look at what's happening in Argentina right now, for example. Brazil has had its share of political instability. When I talk to these executives, they say it doesn't matter because the adoption curve is so powerful, just the thing you're talking about. But how should investors, there is still a risk that investors probably need to be aware of there, no?
Sure. Well, emerging markets certainly have risk. The world's a risky place, and there's a lot of different risks. Certainly, national governance and corporate governance are amongst the biggest problems. And in the traditional emerging market indexes, the emerging market ETFs from people like Vanguard and iShares, the broad, your grandfather's emerging market ETF, they're full of government-owned banks and oil companies, and they have tons of conflicts. They're corrupt often. Petrobras in Brazil, the poster child. I mean, the whole country almost erupted in a civil war after this giant scandal was uncovered at Petrobras. So you do need to be aware of the risk. And you also, this is another reason why I'm quite confident that the emerging market internet companies, the EMQQ companies, are the best way to go, because the corporate governance is very high. As we talked about earlier, the founders of most of these companies, including the two in Latin America, they went to Stanford. They were funded by US investors. Nubank had Berkshire Hathaway as an investor before it went public. So you get a very high amount of corporate governance, high level of it in emerging markets, but political risk remains.
Let's talk about India. Is that, to you, is that sort of the most attractive opportunity here? You talked about, you touched on it.
Well, India is a very special place. I mean, India, if you look at the emerging markets by population, basically we're talking about 1/3 China, 1/3 India, and 1/3 other. And within the other, Southeast Asia is 1/3 of the other, and Latin America is. But India is, on paper, it's perfect. It's the largest country ever by population. Today it set a record. Tomorrow it'll set another record. And for decades, every day it'll be the biggest. It's got the best demographics, the fastest growth, and that's driving consumption, just like we saw in China. You can think of India as like China 15 or 20 years ago, but the main difference is when China was at this part of its growth curve, nobody on the planet had a smartphone. 20 years later, as India hits this growth curve, you can not only get a smartphone in India, but you can get one for as little as $12, brand new. So India is a very special place. They've also got the best human capital. You can just look at the S&P 500, the CEOs of Google and Microsoft. And they've also become incredibly digitized. They've digitized their financial system in an incredible rate. They've formalized the economy. using technology. And I don't think that most investors really appreciate how special India is, and for its internet companies, how early it is.
So I'm curious, I mean, obviously you're a bull on all of this stuff, and you're very positive. When I look at over the next year, I mean, we have had significant periods of underperformance for emerging markets leading up to now.
We've had more than a decade of underperformance.
So is there any reason to believe that we will see that reversion to the mean in the short term? Like, is there anything that's going to stop this momentum that we've started to see?
Well, I don't make short-term stock market predictions.
We'll say let's 12 months, 3 to 5 years. I mean, any kind of time period you pick.
Well, 3, 5, 10 years, there's going to be a massive amount of growth in the emerging markets internet sector. It's happening right now. In terms of them coming back into favor, certainly this year, there is a much higher appetite. Again, emerging markets have been out of favor for a long time relative to the U.S. The emerging markets internet stocks were also out of favor the last few years. And I think the momentum will continue because when we hear it every day, I mean, investors are so much more interested in talking to us today than they were a year ago or 2 years ago. But the flows so far haven't been really that much. I think there's been $15 billion of flows into emerging market ETFs this year, which is, a pittance to, relative to things like, Vanguard's S&P 500 fund. So my gut is it's going to continue, but longer term, it's definitely going to continue.
And just a quick question before I let you go. China, which we haven't, it's a third, but we haven't really talked about that much. Yeah. And that the Chinese internet names have been very volatile. Can we expect that they'll continue to be sort of a more volatile part within the emerging markets universe?
Well, they've all been more volatile than the broad traditional approaches. Look, China got as far out of favor as you could get. It became quote unquote uninvestable, and so in terms of bullish, bearish, the arm broke. The pendulum broke, and so. And you had these, very large, very profitable companies like Alibaba, like Tencent, like Baidu, Pinduoduo, and they continued to generate profits. Their stocks got very low. They bought back tens of billions of dollars of stock, which has helped the earnings grow. And they have legitimate AI. And if you listen to Jensen Huang, we're not ahead of them. We're sort of tied with them. And they have a lot more people working on AI. They have the most patents on AI. So I think that the realization that AI has value, coupled with the incredible cheap prices, I think the Chinese internet companies could still go up a lot, and they wouldn't be expensive.
Kevin, thanks for coming in. Really appreciate it. Coming up, we got full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst, first up, with the government shutdown, we'll let you know which economic data will be affected and how that in turn affects the Fed. Plus, Neptune Insurance, set to begin trading on the New York Stock Exchange, will go live to the floor to speak with the CEO. And as Exxon announces 2,000 job cuts, we dig into the trends to watch for oil and gas companies in 2026. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets. Looking at the major averages here, we're now seeing a mixed picture. Really little changed across the board after a lower open for the major averages. Right now, the Dow is up about 6 points. The S&P and the Nasdaq, very, very little changed. We do have some breaking news that we have to get to. The Supreme Court is going to hear Fed Governor Lisa Cook's case against the Trump administration in his attempt to fire her. Here with what we know so far, Yahoo Finance's Federal Reserve correspondent, Jennifer Schomburger. And I think importantly here, Jen, she stays in the job for now.
Yeah, you have it exactly right, Julie. The Supreme Court has announced it is going to hear the case of Lisa Cook versus President Trump and his attempt to fire her from the Federal Reserve Board in January. As a result of that, she will remain in her position on the Federal Reserve Board through this interim period. Of course, this is going to be a monumental case, a real test of presidential power and the president's ability to remove Federal Reserve governors. The key question here is whether the allegations of mortgage fraud rise to the level of for cause for the president to remove Lisa Cook from the Federal Reserve Board. We know that back in May, the Supreme Court had moved to insulate members of the board from being fired, even as they allowed members of other boards like the National Labor Relations Board to be removed. So this is going to be a very interesting case and likely precedent setting.
And in the meantime, the Federal Reserve is going to be meeting later in October. We don't know what data they're going to have, right, at that point because of the government shutdown.
Right. So not having key government data creates more uncertainty around making these monetary policy decisions, right? It's going to depend on how long the shutdown lasts. We were expecting to have that key labor market report this Friday. Not looking like we're going to get that at this point, but the data had already been collected by now. So now it's just a delay of the actual release of that data. So the bigger question here is, if the shutdown lasts long enough, does it begin to interfere with the actual collection of data? Maybe that's a risk for the key inflation report, CPI, that we're supposed to get mid-month. But while the private sector data are certainly not a substitute for official government data, that is what the Federal Reserve is going to be relying on in the interim, along with anecdotal evidence they collect on the ground from different districts that they operate in, as well as surveys done from different regional Federal Reserve banks. Obviously, we got the ADP report out this morning, a measure of private sector job growth. So that is one that the Fed is going to look at. And that is helpful for telling the story about the sectors that ADP focuses on and measuring that against historical prints of ADP itself to see the trend over the year, but it is certainly not a substitute for the BLS data, the official government jobs data. Now, other private sector data that the Fed can look at to try to get a picture of the economy includes job openings from Indeed.com, housing data from Zillow, and surveys from Federal Reserve banks of Atlanta, Richmond, New York, and St. Louis for reads on employment, wages, and inflation. Again, Julie, it all really is just going to depend on how long the shutdown lasts. Obviously, the Fed meets every 6 weeks, so if they don't get the full informed picture at the end of October, they can adjust in December.
Yes. As if all of this news is not enough, Jennifer, there's something else we want to mention as well. The Trump administration is withdrawing its nominee for the Bureau of Labor Statistics. So what do we know about what's behind that?
Yes, Julie, that's right. Last night, the White House moved to remove their nominee, E.J. Antony, to be the next head of the BLS. No reason really given to me from the White House when I inquired about this, though the president is expected to announce a new nominee very soon, I'm told, and that the president is committed to fixing what the White House calls long-standing failures at the BLS that have undermined the public's trust in critical economic data. And we do know that this jobs data is very critical, as we were just talking about the Federal Reserve and making decisions around monetary policy.
Yes, most definitely. Thanks, Jen. Appreciate it. Well, the so-called October effect refers to fears of a potential shock to markets over the course of the month, but generally tends to be positive for stocks, especially following a September that ends in the green, as the one that just ended did. Markets are pulling back today as the U.S. government is shut down. Actually, now little changed. But my next guest, seasonality could mean a monster rally. Here to break down what previous shutdowns and previous Octobers have meant for the market, Jeffrey Hirsch, Stock Traders Almanac Editor-in-Chief. Good to see you, Jeffrey. So,
how you doing, Julie?
I'm doing all right. There's a lot going on. Let's start with the shutdown and what we've seen during previous shutdowns that could inform what could happen this time.
I mean, it's kind of a nothing burger. If you look at from the market's perspective, we've seen, the market with the scare of a shutdown head down a little bit into it, but there's usually other things involved. And we've seen rallies right afterwards. So I think even the overnight futures are sort of a microcosm picture of that, with, the being down a bit big early this morning and now bouncing back and the market's kind of flat. So, the government shutdown is more jockeying for a position, more politicking than anything. It's not something that the market has historically had an issue with. Most of the time it rallies right after we hit that, either the low just before or right at the beginning of the shutdown. So markets don't really have an issue with it. The returns are pretty solid. Back in 2018, there was other issues going on. The last big ones that we had with the Fed cutting, we're not seeing that right here. And then early in the year, there was a whole lot of issues in 2018. For the most part, it's not so bad for the market. and it's kind of move on. You know, it's news.
Or I guess it's not that relevant for the market, I guess.
Yeah,
the
I hate to break
more
it to
attention
everyone,
to other
but
stuff.
the market's looking at an AI tech boom and a monster Q4 rally here, and this is just some noise. And the Democrats, Republicans have to get on the same page and figure some things out and let them battle it out.
Well, the market may not care, but the people who aren't getting their checks during the government shutdown, they sure care. Right. But yes, point taken that this is not necessarily a market moving event. So let's talk about the things that you mentioned that are market moving events. And let's also talk about seasonality, which is something that you are steeped in, right?
Yes.
So September,
born, bred, weaned, raised on
it. Exactly. So September ended well. What do we tend to see in October's?
Well, I mean, you talk about the October effect. We called it October phobia, the fear of crashes and big sell-offs and massacres that we've had in October. But really, going way back to even the 1969 almanac that my late father put out, October's a bargain month. It's the best time to buy stocks. It's a bear killer. Best time to buy stocks, especially small caps and large caps. And we see a general turnaround sometime in the month, depending upon what happens. Coming into this year with the market being up for the 9 months and hitting 8 new all-time highs. Maybe it was even 9 yesterday we didn't have one. In September, bearish September is bullish. When bearish seasonality doesn't happen, it's a bullish indication. We've seen one loss in 1967 in those years when we had all those new highs in September. We've got a worst 6 months period, the sell and May period that was also up at the second best worst 6 months ever. We've seen no losses in the fourth quarter, year-end gains, fourth quarter gains in the 6-7% range, year total gains over 20%. So we're looking at a potential for a monster rally, S&P 7100, and another 20% year for the S&P.
Wow, 7100 here. What could be the fly in the ointment? Is there anything that could change this outlook?
Well, there's always exogenous events, something in the Middle East and Russia and China, some systemic issue. But, the jobs number, people are concerned about that. And yes, employment is an issue, but a lot of it may be impacted by the lack of immigration and the things that are going on with that end of it. And, all the data that's out there. I mean, I did a whole chapter in my book, Super Boom, that I put out about inflation data being manipulated or at least adjusted. And there's all these economists doing things. If you just look at some of the, unadulterated data like jobless claims, I think you can get a good picture of where we're at. The economy, robust. And if you want to find out about inflation, just, step outside. Go to the store, see what things are happening. There's inflation out there. We all know that. There's shrinkflation, there's inflation. So the government shutdown with everybody worried about not getting their data, I think it's less of an event and more just something that's going to give us a nice little buying opportunity here in October and set up that, textbook October buy.
All right, 7100. You heard it here first, folks. Jeffrey, thank you. It's good to see you.
Thanks, Julie. Good to see you.
Well, Neptune is making its trading debut. It becomes the 6th U.S.-based insurance sector company to go public this year. And we're talking to the CEO of the flood insurance provider next on Market Catalysts. Neptune Flood is set to begin trading on the New York Stock Exchange today after raising $368 million in its IPO, selling 18.4 million shares at $20 each. The pricing gives the flood insurance provider a market value of about $2.8 billion. We'll see where it opens up. And joining me now is Trevor Burgess, Neptune Flood CEO, joining us from the floor of the New York Stock Exchange. Trevor, congrats on the IPO and thanks for being here.
Thank you to be here and happy to be here on the day of the government shutdown.
Yeah, exactly. We're going to talk about that in a moment, but I do want to talk about your business. Flood insurance for a lot of folks is tough to get right now, right? Some places are considered uninsurable. So what do you come in with into this market that is different from what we have seen traditionally?
Listen, for 50 years, the only way to buy flood insurance was through the federal government, through the NFIP, which happens to be closed today. What Neptune offers is a better product that's easier to buy. So we offer up to $7 million of coverage on your home instead of only $250,000. We'll cover temporary living expenses when you're flooded out of your house. And really, we're focused on how do we get more Americans covered for this most dangerous peril. It's incredibly underinsured because people mistakenly think their homeowner's policy covers the risk of flooding when it doesn't. You have to buy a separate policy, and today the place to buy it is Neptune.
Well, and it's also probably undercovered because, again, some people just feel they can't afford the premiums because in some cases the flood risk is, in many parts of the country, the flood risk is pretty high, and so the premiums therefore are very high. So how do you sort of address that, or do you just have to charge those high premiums to some folks?
Listen, what Neptune does is totally different than the federal government, who uses low-risk policies to subsidize high-risk policies. We've always told the truth to the consumer around their risk is associated with the price. So if we tell you that it's $300 a year, that's pretty low risk, but you should still buy a policy. If we say it's $10,000 a year, you should really think about whether or not that's a house you want to buy, right? We're telling the truth to the consumer that they can make really valid risk decisions.
And I'm curious, you guys, you underwrite the policies, but you don't hold the policies, right? That's something that you outsource to financial institutions. So talk to me a little bit about the thinking behind that model.
Yeah, so Neptune is a software company. We've built an artificial intelligence engine powered by data science that does a really good job at underwriting that flood risk, at selecting the risk, pricing the risk, and then we allocate those policies to 7 large global insurers who then actually take on the risk. It's a really neat model where we can focus on what we're great at, which is this artificial intelligence, data science driven company.
And you guys are also profitable, which is not a given for IPOs ever, and especially recently here. So what can you tell us about what the growth outlook looks like going forward on both the profitability and on the revenue front?
Yeah, Neptune is a new breed of company. We were AI native from the very beginning. So everything we have built is with super efficiency. We have 60 employees and 260,000 customers. That means we have revenue per employee of $2.5 million, EBITDA per employee of $1.5 million. It's a very, very efficient model, and we're able to use technology to efficiently grow.
I want to circle back around to the government shutdown, right? How at all does this affect your business when you see something like this happening?
Yeah, so there are 1,300 homes a day that require flood insurance in order for their purchase to close. If you live in a high-risk flood zone and you have a government-backed mortgage, you're required to buy flood insurance. That's from the NFIP or from Neptune. With the NFIP closed, Neptune's one of the only games in town to be able to actually insure your home and make sure that your home closing can still take place today or tomorrow. I hope the government shutdown doesn't last a long time, but while it does, Neptune's going to be able to prove to the national market that we are here and we're able to help and we can make sure those home closings can still take place.
Interesting. I imagine part of your quest here, Trevor, is to let people know that you even exist, because as you say, there hasn't been that alternative in the past. Is that part of the reason why you guys decided to go public, to sort of up the profile, get more funding to get the word out?
Yeah, the number one reason that we're going public is to build that national brand, to let consumers and insurance agents know that they have a viable alternative to the NFIP. And it's a great day to do it, to tell the story when we're open for business and the NFIP is closed.
So do you expect that sort of uptick in volumes?
Well, we'll see. We're working on getting the word out. We're communicating with our agents. We're communicating with consumers and letting them know that if they have a home closing that's in jeopardy today, they should check out Neptune. We hope that we'll be able to help and make sure that their home closing can still go on as scheduled.
Trevor, thanks so much for joining us. We really appreciate it.
Thank you.
We got more markets action coming up. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Allie Canal, live at the NASDAQ, and we're tracking some of the day's biggest analyst calls on Wall Street. Kicking things off with AppLovin. Bank of America raising its price target on the ad tech company to a street high $860 a share. That's up from the prior $580 and nearly 20% upside from current levels. The firm says that AppLovin is becoming a, quote, required channel for e-commerce advertisers, especially in high consideration categories categories like apparel, health, beauty, and home goods. BofA also sees tailwinds from a newly launched referral program, which could help expand AppLovin's reach to thousands of direct-to-consumer merchants. Next up, Delta Airlines. Jefferies upgrading the stock to buy from hold and boosting its price target on shares to 70 from the prior 62. Analysts saying that they have increased confidence in the revenue trajectory for the company, calling Delta a long-term margin leader. The firm also flagged stronger Q3 and Q4 top-line momentum, adding that EPS estimates for the current quarter and full year 2025 now sit above consensus. This call adds to a string of bullish targets across Wall Street, with firms like Evercore ISI, JP Morgan, and Goldman Sachs all projecting upside into next year. Finally, Coinbase. Shares rising after BTIG initiated coverage with a buy rating and a $410 price target. That also implies roughly 20% upside. Analyst Andrew Hart calls Coinbase one of the most trusted brands in crypto, saying it's well positioned to benefit from rising stablecoin adoption. BTIG also sees its derivatives business and Base App as key underappreciated growth drivers, especially following the recent Deribit acquisition. And that's a look at some of this morning's top analyst calls. Stick with us. We've got plenty more market movers coming your way on Yahoo Finance.
Now, time for some of today's trending tickers. We are watching Peloton, Conagra, and Cal-Maine Foods. First up, Peloton, the company unveiling a sweeping product revamp. Here to break it all down, Yahoo Finance's Brooke DePalma, and I guess we get straight to it. The market does not like this product revamp.
The market certainly does not like. I mean, Peloton has just been roiled since we saw that high back in 2021 of about $151. It's now down about 68% to $8.52. But consensus on the street is still seeing a $10 average price target. But shares have really been under pressure today because of these unveiling of the new products. It includes everything from a more personalized product lineup when it comes to their tread, their strength, as well as that key bike that they've had, throughout time. Also, rowing has also been something they've been invested in. But this Peloton IQ, it's something that ultimately will allow someone to really lean in to put in their weight, put in their goals as well, and create that personalized experience with now these new products assisting that introduction as well. Now, the CEO did say that Peloton, quote unquote, was made for this moment as they really look to reshift and reinvigorate sales. But like you said, the verdict's on the street, not too happy about this.
Well, part of it is the price. There's a price increase that comes with all of this as well. These prices are going up quite a bit.
Yeah, and what we've heard from analysts on the street is that how much pricing power does Peloton ultimately have at the end of the day? How much will the initiative be to ultimately, buy these new products, especially if you already have our former suite? But, Citi saying that they're encouraged with the mix shift to newer models around wellness and strength, but they are looking for further details around if this pricing will work out.
Yeah, just one example here, the basic bike going up to $1,695. That's a $150 increase. So that's not small. All right, let's talk about Conagra as well. The packaged foods company reported quarterly profit that beat estimates, but warned that inflation and tariffs were pushing up costs. So the shares are actually trading higher here, Brooke. So tell me about that one.
Yeah, so the shares are trading higher based on the fact that they beat those low expectations that Wall Street had moving in. This stock has been under pressure year to date, down about 31%, as investors really try to understand, consumers are pulling back on snacking. So where does this company stand at the end of the day? But what they did see was such momentum around their frozen business as well as their refrigerator business. They saw both frozen and refrigerator business return to volume growth for the first time since last fall. That was driven by what they said was hot dogs, frozen meals, especially frozen meals that have protein in it, and also those Slim Jim snacks. Well, those continue to do well as consumers seek out higher protein meals. But they said that the consumer is not out of the woods yet. They're still managing inflation as well as the impact of tariffs, which they said will hit inflation by about 3%.
Let's stick with food and talk about Cal-Maine Foods. It's an egg producer and it's slumping after its first quarter results here. It's off about 1.6%.
Yeah, this was a stock that really soared over the past few years, especially over the past 5 years, as we saw that increase in egg prices really take off. And now we're seeing a bit of a pullback here. Right now, they, their adjusted earnings per share, their revenue, both came in lower than what Wall Street had projected. And this is a company that really gained such momentum, especially back in early 2023 after those egg prices hit an all-time record high. And now we're seeing egg prices come down a bit. They're about $3.58. That's the lowest they've been since October of 2024. They also said that their specialty egg business and prepared food business has been doing well for them. But this is a company that, has been up based upon that momentum has gotten from higher egg prices. Now we're seeing that come down a bit. There's also not too much coverage from Wall Street. There's only 1 buy and 3 holds on the stock right now.
Yeah, and it seems like that specialty egg business, some of their competitors are gaining market share, and just in general, people are turning to more specialty eggs, free range, organic, etc.
Especially when the prices have been comparable.
They've been approaching each other, exactly, and that's a small part of their business, right?
Yeah, specialty eggs make up about, they said, 30% of net sales, and so the momentum there and the investment there, they're making in both specialty eggs as well as prepared foods. They think that that's a growth driver in years to come. Of course, now that shell eggs, the demand and the inventory there seems to be under control far better than where we were a few years ago with the avian flu.
Yeah, definitely. Thanks, Brooke. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, ExxonMobil is the latest big oil company to announce job cuts, in its case 2,000 worldwide. This follows the likes of Chevron, ConocoPhillips, BP, each letting thousands of workers go earlier this year. Those oil giants getting leaner as crude prices have dropped over 12% this year. Our next guest sees these trends potentially continuing into 2026. Joining us now, Nivan Borajardi, Wood Mackenzie Director of Corporate Research. Thanks for being here. So this trend of sort of slimming down as we've seen pressure on oil prices, how is that going to continue to develop next year?
Yeah, I mean, companies at the moment are really caught between competing short-term and long-term pressures. In the long term, despite the fundamentals for, oil and gas demand still looking pretty strong, the reality is, these companies have got oil and gas production profiles, resource bases that are much more aligned with, 1.5 and 2 degree scenarios. So they recognize that they need to add more longevity, more volumes to the business. But of course, we've got these short-term competing pressures, one of which is absolutely price. Wood Mackenzie sees Brent prices falling to below $60 per barrel on average next year. And when we start to get to those prices, most companies are starting to outspend their cash flow. So they're having to look for various levers, whether that's leaning on the balance sheet for companies that are, in a particularly strong financial position, they can do that. But for most companies, they do have to pull other levers. And one of those is clearly cutting costs.
What are some other ways that we may, if they're bringing down headcount to some degree, but at the same time, it also feels like we're still seeing investment in things like technologies, right? So where are we going to see maybe a pullback in investment?
I mean, I think first and foremost, we're seeing companies dial back share buybacks. That's one that's often first to go during periods of low prices. We're already starting to see evidence of that. But I think in other areas where we could see advancements is in upstream. There is a slight recalibration back towards upstream investment to try and tackle those long-term challenges. And as you say, I think technology is one, because if companies can develop AI, if they can start to reduce costs, that all adds to the sort of value creation story. I think one area I didn't mention there in terms of dialing back is obviously low carbon as well. Low carbon has had its challenges, whether it's offshore wind in places like the US. And oil and gas companies are definitely dialing back from those investments.
Right, it's come out of vogue, and we're not seeing the same sort of incentives that we once saw. Nivan, I'm also curious about the M&A landscape, because for a few years there we had seen quite a lot of movement, even if it wasn't, in some cases it was big mergers, in some cases it was buying up properties. Where are we in that cycle? Is that paused now?
Yeah, look, volatile prices, whether they're high, whether they're low, they're not exactly conducive to M&A. But, I do think some buyers, those that have got, long-term strategies in upstream, those that are here to kind of stay in oil and gas, they may look at this as an opportunity to pick up assets at lower prices, or even, buy in companies if market valuations fall in response to this drop in Brent price. So when you're thinking about potential buyers, you are looking at those companies that have got, rock solid balance sheet strength. You're also looking at companies that are doing well in the stock market, and that gives them the equity currency to go and do some of the all-share deals that we've seen in the US over the last couple of years.
Yeah, I mean, here in the US, it's tougher to find those outperformers in this market, at least in terms of how the stocks have done this year. There are some, but it's tougher to find them. So that also brings me to another question, which is, do we see differences going forward in terms of some of these operating challenges between some of the U.S. operators versus the European operators and others?
Yeah, I mean, look, the Euro majors were much quicker off the mark, right, to make commitments into low carbon, moving into areas like renewables, CCS, hydrogen, and that has left their longer term portfolios in a much weaker position than their US counterparts that you mentioned. Over the last couple of years, we've seen Exxon and Chevron do really big deals in the Permian and Guyana to really strengthen that long term business. And investors have allowed them to do that. It's been a very different story here in Europe. The Euro majors haven't been reinvesting as much money back into the business, and to be fair to them, they've not had the investor ability to do that either.
What role is AI playing across the industry? I remember talking to somebody at CERAWeek a couple of years ago, the big oil and gas conference down in Texas, and they said, the industry kind of had a ways to go on this front. So how much progress have they made?
So I think in the Permian, we're seeing, big operational improvements. We're already starting to see evidence of costs coming down. Some companies will say that's down to AI. Some will say it was down to, other synergies. I'd say for the most part, we've yet to see the real evidence of the improvements delivered from AI, but we see lots of potential. Now, whether that's in areas like exploration, identifying analogs, doing things that analysts like myself in an office would take a long time to do, and really shorten that time frame and getting companies really kind of focused on some of the best opportunities. So that's certainly one area where we can see improvements. And yeah, in other areas it's like automation, it's reducing costs, reducing headcount, but yet to see the evidence yet, but obviously the potential is there.
Yvonne, thank you so much for the analysis. Appreciate it.
Thanks for having me.
All your markets action coming up. You're watching Market Catalysts.
The fourth quarter is upon us, and October has a volatile reputation in the markets, which it has earned. It's where the pressure tends to build and where it often releases in many years, letting the market sail into a year-end soft-bedded Santa Claus rally if history repeats itself. Today in Stocks and Translation, we are breaking down the volatile seasonal tendencies of this storied fourth quarter. And let's start with the beginning with a definition of a market crash. It isn't just a bad day. It is a sudden, steep drop that vaporizes value in days or weeks, often fueled by panic and forced unwinds. That's when selling itself causes more selling. And although we've seen market crashes in just about every month of the year going back a century, for some reason, some of the big ones have clustered in the second half of the month of October. Now let's take a look at some of them. Nearly 40 years ago in 1987, so-called Black Monday on October 19th became the template for modern panic, as the Dow crashed over 20% in one day. But on October 24th, 1929, nearly a century ago, Black Monday kicked off the bear market that marked the beginning of the Great Depression. Also on the 24th, but in 2008 this time, after the fall of Lehman Brothers amid the global financial crisis, the VIX Volatility Index hit an eye-watering 89.53, an all-time high that survives to this day. Then on October 27th in 1997, we had a mini crash which triggered the first market-wide circuit breakers in the modern era, which were put into place after that 87 crash. The good news is not every year has these cataclysmic events. So let's take a look at what's happened quarter by quarter in the S&P 500 since 1990, something we call seasonality and like to talk a lot about here. What jumps out is the outsized median return in Q4 to the right of your screen, 6.5%, which tends to be positive over 80% of the time. Compare that to the first 3 quarters of the year, which tend to see returns of less than half of that in the 2% range, with only about 2 and 3 years being positive. And even when October spikes lower, November and December tend to grind higher historically. In this chart here, we've sliced and diced the data a little bit differently. We're only looking at the first year of each president's 4-year term, going all the way back to 1949, which has happened 19 times. Here, Q4 is still the best, with a median return of 5.5% and a win percentage that's near 80%, pretty close to the prior map. You can also see how returns tend to get better each quarter as the year progresses. Now let's take a look at what typically happens in the VIX Volatility Index each year. That's in white versus what's already happened in 2025, which is in green. Notice how the white line climbs higher in August, September, and October, then it peaks and falls into year-end. That lower year-end volatility is what typically supports predictable December gains and the so-called Santa Claus rally at the end of the month. But I should point out that in 2018, we had a near bear market in December, which had the worst return since 1931. Guess what? That was also when we had the last government shutdown. But as we showed earlier in the week, shutdowns don't tend to rattle stocks too much. They're more of a bond market mover. So what should investors be watching right now? Let's start with that economic data, assuming it's even released on time. The monthly jobs numbers are scheduled for Friday, October 3rd, while CPI inflation is set for Wednesday, October 15th. But watch out for shutdown-related delays. There's also a Fed meeting at month end, but that shouldn't be affected by government closures. Then earnings season will set the tone when it kicks off in mid-October with the big banks. Listen for margins, investment forecasts for 2026, and how the AI spend is progressing. Then, as earnings season matures, the corporate buyback window reopens, a topic we recently covered here on Stocks in Translation. After companies report earnings, they can buy back their stock again, which supports the markets. And speaking of markets, watch the dollar and bonds. That's where trouble usually shows up first. Big movements sometimes spill over into stocks. Bottom line, October may bring the thunder, but history says that the sun usually breaks through before year's end. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market catalysts up next.
The commercial real estate market has been navigating an uneven path in recent months. The One Big Beautiful Bill Act passed in July injected both headwinds and tailwinds into the market. So which way is the wind blowing for your investment dollars in the CRE market now? We're joined by David Blikre, Newmark Executive Managing Director of Global Research. Good to see you, David. So first of all, let's just talk very big picture, right? Mm-hmm. And we might as well start with the bill, right? The tax bill, and sort of what are the high-level pros and cons, and how are they now making their way through the market?
So the big pro is bonus depreciation. So like imagine that you're building out an office space, and you might think that the rent's the big problem. The build out can be very, very substantial, over $100 million for a large space. Your tenant improvement allowances, they're coming from the landlord, maybe only cover half of that. Depending on how you structure your lease, all of that can be depreciated in the first year under the bill. Anything except for some structural improvements. And depending on the tax rate of the relevant folks, that can be on a $100 million build, you could be looking at $7 million in tax savings.
So that seems like a positive. What about any negatives?
Negatives, some of the things we're looking at is you look at things like reductions in SNAP payments. There are a significant portion of retail and food sales, including for some major major retailers, who derive a lot of revenue from those. So if you have a reduction in benefits and it's not completely offset by folks finding other sources of income, which I think most of the forecasting suggests that there would be a net reduction in spending from that, then it's going to hit the bottom line of some food retailers.
Let's talk about some of the other subsectors as well. And something obviously we talk a lot about here is what's going on in AI and the data center build out. So is that, from a real estate perspective, are there a lot of investment opportunities there, and how is that going to develop?
And this is, I mean, it's huge for real estate. I mean, anytime you're building something in the real world and not just in cyberspace, especially if you're building things to build things in cyberspace, it's going to help. So we're seeing it impact in a variety of ways. So like one is that there's a incredible growth of AI companies who over the next number of years are going to lease office space. In the Bay Area, where I'm coming from, we're tracking over 1,000. On the industrial side, there's tremendous logistics and manufacturing demand associated with the build out of the AI infrastructure. You need to move steel, you need to move specialized parts, you need to build power. That is one of the biggest impacts. One thing that we'd also notice is that if you're looking at development sites for industrial, now they're competing very heavily with data center. You have investors looking at existing industrial facilities that have power, they have grid, and looking at them as covered land plays for future data center development. So there's just kind of a kaleidoscope of ways that the AI revolution and the associated infrastructure build out are impacting every kind of real estate. On the retail side, we're seeing we expect AI to become an important part of helping companies find their consumers. And this could drive more and more spending and ultimately improve the value of both logistics and retail real estate.
At the same time, in terms of competition for investment, is that goal, sort of rush into those types of investments, sort of starving other areas of investment?
I don't think that we're seeing a crowding out on the capital side. I mean, if anything, we've seen spreads coming in for debt financing. There's still capital being raised onto the equity side, and we expect that to start to pick up, particularly because the leading indicator is the debt side, where liquidity is very, very strong. I think that you'll find some areas like we kind of talked about. You have someone who wants to build a data center, and you have someone who wants to build an industrial facility. They're competing for the same place. So it could make it harder to develop new non-data center real estate. In some areas, same things, you're competing for the same labor that goes into building various kinds of commercial or non-residential structures. And if anything, that should redound to the benefit of the owners of existing assets.
And then finally, just a quick mention of office, which obviously has been real challenged. It sounds like you think that office could be bottoming. Is it bottoming or has it bottomed?
I think it really depends on market. Overall, I mean, we're looking at, if you're focusing on mature corridors in top markets, and that's from Manhattan to Dallas to Atlanta, to Boston, we're starting to see these trophy buildings outperform. Just to give you like a concrete example, if we look at our trophy buildings in Midtown in Manhattan, the availability rate's 5%. Rents are growing there. We could look at other markets, whether it's like Uptown Dallas, or Century City in Los Angeles, and we're starting to see strong performance there. And I think it's important to focus on the specific submarkets and the specific quality and occupier or tenant profiles, rather than looking at the overall numbers.
David, thanks.
Oh, sorry. Yeah,
that's okay. Finish your point.
Yeah, if you have a tenant who's looking at a trophy tower, it doesn't matter how cheap a 1980s built, like polygon office building is, they're never going there. So there's a really dramatic segmentation between quality seeking and cost-oriented tenants in the market. And the quality-oriented tenants are driving these trophy markets.
David, thanks so much for your analysis. Appreciate it.
Thanks for having me.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.